I think the nice thing about our business is we have the option to do nothing. And if you think Bitcoin's only going to grow 10 or 20% a year, our default is we just do nothing and we grow at the rate of Bitcoin, and we're okay with that. And then if we think that there's something very accretive that's going to be good for the shareholders, then we will participate. And we can participate, in size, 1 million a day, 100 million a day, 1 billion a day. And the truth is, Pete, sometimes we get up in the morning and we basically set up our programs and we think, well, nothing's going to happen today. And then 5 minutes before the market closes, a lot of stuff happens.
Michael Saylor starts by explaining that MicroStrategy's approach to Bitcoin is not about short-term trading or reacting to market noise, but about building a long-term financial strategy centered on digital capital. He clarifies that the company's past decisions to issue equity or take on debt were not meant to dilute shareholders for quick gains, but were strategic moves made under pressure to strengthen the balance sheet and position the company for long-term survival and growth. According to Saylor, MicroStrategy had to restructure portions of its debt to get rid of restrictive conditions that reduced flexibility and raised risk at several crucial points due to financial restrictions. These efforts were important to safeguard the company's future and strengthen its capacity to store and accumulate Bitcoin over time, even though they were occasionally seen as weakening in the short term. He highlights that the company's strategy is based on gradually increasing its exposure to Bitcoin while preserving financial resiliency, and that it is a superior form of long-term capital.
We try to be very reactive to market signals. So for example, when our equity trades weak, we don't sell it. When our credit instruments are trading weak, when the cost of credit is too high, we don't sell them. The most obvious is STRC. If it trades below 100, we don't sell it. So in periods where the marketplace loses confidence in our particular credit instruments, we simply wait. And in periods when the MNAV of the equity explodes to 3 or 3.5, we might sell $1 billion a day, right? So when the capital markets are enthusiastic about either the equity or the credit, we react to them. And it's above our pay grade to set financial policy. It's even above our pay grade to interpret like the financial policy. Like sometimes the macroeconomy has one set of numbers and you would think it's good for Bitcoin, but it's bad for Bitcoin. Or another time you would say, well, if they do this, that should be good for us, and it's not good for us. And then other times it's the opposite. I think the nice thing about our business is we have the option to do nothing. And we have a set of disciplined capital markets programs. They've moved from being discrete, where it's like, well, we got to do a deal this quarter. What's the deal we're going to do in Q3? And we've moved from discrete 144A capital markets programs to continuous ATM type programs. And with the ATMs, if the market thinks that the cost of capital on an instrument like STRF should be 11%, well, we just don't want to sell it. So we think it ought to go to 8%. So when the market takes STRF to 140 or whatever the price it is that we think is fair, then we will be open to issuing more. And when the market is bearish on those instruments, we don't. And the good thing about the business is, if you think Bitcoin is going to grow, fill in a number, 30% a year, then our option is just do nothing. And we're a company that's a $45-50 billion company growing 30% a year. So that's our default. Our default, if you think Bitcoin's only going to grow 10 or 20% a year, our default is we just do nothing and we grow at the rate of Bitcoin, and we're okay with that. And then if we think that there's something very accretive that's going to be good for the shareholders, then we will participate. And we can participate, in size, 1 million a day, 100 million a day, 1 billion a day. And the truth is, Pete, sometimes we get up in the morning and we basically set up our programs and we think, well, nothing's going to happen today. And then 5 minutes before the market closes, a lot of stuff happens. Like it can literally change in 60 seconds. And again, that's beyond, our control. We can't control how the markets will interpret all these things. What we can do is set up a rational set of credit structures so that we only issue credit when we think it's in the best interest of the company, and we only issue equity when it's in the best interest of the company. We don't aim to reproduce those weeks. The times that we've actually done dilutive transactions on a Bitcoin per share basis, where if you go back to the crypto winter when we had to recapitalize some toxic debt on our balance sheet, we took out debt, either it was like asset-backed loans or senior debt that had EBITDA covenants that we felt were crippling the company's growth prospects. And so we didn't do it enthusiastically, but we did it because over the 10-year time frame, we knew we needed to remove those toxic elements to our balance sheet. If you look at these 3 weeks, when we took actions that were somewhat dilutive, they all were generally associated with building up the US dollar reserve. And we did that in response to analysis and feedback from the market and some reflexive concerns that we wouldn't be able to pay the dividend if the equity capital markets closed to us. So we wanted to get ahead of that and address the credit quality. So the reason we did it, and the short answer is we do it to improve the credit worthiness of the company. And if we felt that there was a credit problem, we would do it. Right now, we feel that we've built the US dollar reserve to the level where we don't have a credit problem. We're good for the next few years. We don't have any of those other forms of debt, the senior debt or the asset-backed lending. So the balance sheet is in much better shape today. Going forward, we wouldn't electively or programmatically issue equity to buy Bitcoin if it was going to decrease Bitcoin per share. Right, where we don't think that's a good idea. We would only take those actions when we feel like it's essential to defend the credit of the company, because if people lose confidence in the credit, then that will ripple into losing confidence in the equity and then losing confidence in the business model in general. So it's a practical consideration. But I don't think we expect to see anything of that magnitude going forward, because the first $2.25 billion of US dollar reserve was a big move. The second topic is really what are the catalysts for Bitcoin price to improve. Look, I think the fundamental catalysts are regulatory support. We have the most constructive set of financial regulators in the history of the industry right now. The head of the Fed, the head of the Treasury, the head of the CFTC, the head of the SEC, and the White House has a digital assets czar, right? Those 5 things are massive bull flags. They're all very positive, and generally you would expect that something good will come probably out of the CFTC or the SEC as they are constructive about facilitating financial companies to innovate in the digital asset space, right? I would have been skeptical about that 2 years ago, but I think for you to be skeptical about their support for digital innovation today would be ignoring all the words from everybody in those positions. And I think that the second catalyst will be banking adoption, the formation of the banking credit networks. As the large banks and as companies like Schwab, they start to allow you to trade Bitcoin, custody Bitcoin, borrow against Bitcoin. They're going to legitimize the asset, and they're going to decrease the volatility of the asset. They're going to improve the usefulness of the asset. You're aware of the announcement of the BlackRock Bitcoin Volatility Income Fund that came like about a week ago, where they said they were going to sell volatility or generate income. And there's a lot of people that speculate that will decrease the volatility of Bitcoin and put a more stable floor into the asset. So I think the actions by big finance, the actions by the big banks, and the actions by the financial regulators are the fundamentals. I mean, those are the fundamental things. And if you were to light a candle and pray, to the gods of the crypto sphere, you would say, I want pro digital assets regulators, I want pro digital assets banks, and I want pro digital assets financial innovations like BlackRock's bringing to the market, like we're bringing to the market, right? Like STRC. But fundamentally, the industry is going to move forward because of enlightened regulation, engaged, thoughtful banking, and then innovative finance. And that's what we're doing, and that's what we see right now.
Great. Thank you, Michael.
Saylor highlights one key risk above all others: dilution created by unnecessary complexity. He explains that when a company's financial structure becomes harder to understand, whether through complex deals, unclear liabilities, or layered capital arrangements, it can weaken investor confidence and increase overall risk. In his view, markets reward simplicity. Credit investors want stability and predictability. Equity investors want strong performance relative to Bitcoin, and both groups depend on clear communication and transparent financial structure. Because of this, Saylor is cautious about acquisitions. While buying other companies may create value in some industries, he believes it often introduces integration problems, operational distractions, and additional risk that can pull attention away from the core mission. Instead, MicroStrategy keeps its focus narrow and disciplined, increasing Bitcoin per share while maintaining a strong and stable credit profile.
We generally won't get distracted, right? The number one risk for us is a dilutive distraction, right? Everything else on our capital structure that undermines the credit of stretch, is a question mark, right? So you have to be thinking about that. And then anything we might do that looks complicated or risky or different would anything that introduces a question in the mind of the stretch investor: can we pay the dividend? That's going to be deemed negative. Anything that introduces a question in the equity investor's mind: can you outperform Bitcoin? So generally we're pretty skeptical on acquisitions because they take a long time, and then you might acquire something that you didn't want that you have to divest, and then everybody wants to talk about how and why and how long it takes, and so I wouldn't say it's not a good strategy for other companies and other investors. There are other companies and other investors for which it's a great opportunity for them, and they can make a lot of money and they will pursue it, and God bless them. For us, we believe we've stumbled upon maybe the most promising product, STRC. After 20 capital markets transactions and all sorts of credit instruments, we think we found the best one for us and for the credit investor. And we think we found a great business model, right? The treasury company. If you can generate return of capital dividends scalably and scale up the issuance of treasury credit, you've got maybe one of the most efficient business models in the world and one of the most compelling products in the world. So we don't want to do anything that would dilute that focus, undermine the credit of the balance sheet, or distract the management team from what we see is a once in a lifetime opportunity. Another point to make is we can't lower the rate more than 25 basis points a month. So we're always going to be very incremental, and we would only lower the rate when in such a way that we thought it would stay in that zone of 99 to 101. Like we want to keep it targeted at 100. So, you might 5 years from now find out that the rational credit spreads that the market assigns us are 300 basis points instead of 600, and that people would like to buy this thing at 400 basis points over SOFR, maybe. But we would very gradually get there, and we would still expect STRC to be trading around 100. And so we're not looking to do anything that is jarring to the price. We want the price to be stable. As a practical matter, the reason that we would lower the dividend rate would be we had such an avalanche of demand. We had too much demand, and people want to buy infinite, and we don't want to sell infinite because we'll drive the BTC rating of STRC down. Right? Like if hypothetically someone said, I want to buy $100 billion of STRC tomorrow, you can see how we don't want to sell it because, right? Yeah, because then that reflexive and that would undermine the credit quality and that would increase the volatility and that, that kind of works against everything. So luckily for us, and practically that's not going to happen, right? Like, they say, it's good that we have time because otherwise everything would take place at the same time, right? All at once. We don't want stuff to happen all at once. So it will happen progressively. We'll be very thoughtful about it. Our goal is always for it to be extremely compelling to attract capital. And at the point where we feel like we've got too much capital, it would be a circumstance, Larry, where there was massive success of STRC and Bitcoin was lagging. And MSTR equity premium was lagging, and there's that weird situation where it's hard for the company to increase its collateral base in order to back the credit. And then we would say we have too much demand for the credit, so we need to click it down. But if there's over demand for the credit, it would still be pegged at 100 when we take it down 25 basis points, and so. We're going to responsibly manage this so as to minimize volatility, maximize stability, and in all likelihood, it's going to be excessively compelling in terms of dividend rate for quite a while. Because even though you believe in Bitcoin as collateral and I believe in Bitcoin as collateral, we've got a lot of work to do with credit rating agencies and the Basel rules and traditional finance establishment before they recognize it as being good collateral. And as long as they don't, then that means probably the spreads are going to stay pretty compelling.
Fair enough. Thank you very much. Really appreciate it.
Michael Saylor emphasizes in his conclusion that three key factors, supportive regulation, active banking institutions, and financial innovation from firms like BlackRock and MicroStrategy, are driving the future of cryptocurrency and digital finance in addition to technology. He explains that the entire digital asset business will continue to expand and evolve in a robust and sustainable fashion if these three factors remain in line: clear regulations from regulators, active bank participation, and ongoing product innovation. However, he stresses that the biggest internal risk for MicroStrategy is not competition or market volatility, but anything that distracts or dilutes the company's core strategy. In his view, anything that makes the balance sheet more complex, raises uncertainty about credit stability, or confuses investors about performance relative to Bitcoin is something to avoid. He is especially cautious about acquisitions or complicated financial moves because they can slow execution, create integration problems, and raise unnecessary questions for both credit investors and equity holders. In the end, Saylor highlights that this entire system depends on time, discipline, and gradual acceptance from traditional finance. While Bitcoin is becoming recognized as strong collateral, institutions, regulators, and rating agencies still need time to fully adjust. Because of this, he expects spreads and returns to remain attractive for a while, allowing MicroStrategy to continue building its strategy slowly, carefully, and with long-term stability as the top priority.